Okay, so now that we understand a bit better how to manage risk, what that means, the tools we have in place, I mentioned just momentarily at the end of chapter 3 that if we want to move to a more complete or holistic view of risk management from an enterprise or firm perspective, then we move to something that we would call enterprise risk management. And that's the bulk of what we're going to be talking about in chapter 4. And then we'll move slightly a little bit beyond that and talk about alternative ways to deal with risk from an institutional perspective. So I have a couple of quick links here. This is just to kind of bolster the material, the gist of all this. Again, for time reasons, we won't watch these videos, but these are 2 videos here. The gist is that these risks, again, like I've said over and over, they're dynamic. Okay? They're quite dynamic. The risks that we face now, very different than what we faced 10 or even 20 years ago. It could be something as simple as your CEO on Twitter saying something he should or should not say. That's a risk that we did not have 20 years ago. So with new technology comes new risk or different risk. So keep that, again, in the back of our head here. All right, so today the risk manager, you're not just buying insurance policies. Okay, and I think you guys probably have an inkling of that based on our discussions prior, but you're not just buying insurance policies. And again, we assume if firms are risk neutral, they should never buy insurance anyway. It's a negative NPV project for them. Okay, but they do buy insurance for a number of reasons. But something we really haven't discussed too much is not just always pure risk. Right? What firm only focuses on or only sees pure risk? Most firms have a combination of pure and speculative risk. Commodity price risk, interest rate risk, those are not pure risk. So the risk manager may be using either financial risk management, and commodity pricing again is a good example, or what we're going to spend time on today, enterprise risk management. So enterprise risk management, or ERM, is this holistic approach, and holistic view, and we're going to take all the organization's risk, all of them, and address them. Because we know they're probably somewhat correlated. They're probably somewhat correlated. So why are we going to just separate them? Separate each functional unit of the business and have this silos mentality when that's not the way the world works? Why are we keeping it compartmentalized like that? There might be some lines, but they're very blurry. Now, even if they are correlated, as long as they're not perfectly positively correlated, you still get advantages from things like pooling. So in our pooling examples, we didn't introduce correlation because it really just makes the math more time consuming. If we did, we would see very much the same thing, that our kind of per unit deviation or risk would continue to decrease, even with some positive correlation. Now keep in mind, again, we're not really talking about diversification here. Okay, pooling and diversification, those are separate ideas. So be mindful of that. Now, 2 years ago, the Risk and Insurance Management Society found that 92% of the firms they surveyed, so there's a selection issue here. So those who agreed to do a survey by RIMS, so there's a selection issue. But still, 92% said we have some ERM program in place. We jump back to 20 years prior to that, or excuse me, 10 years prior to that, 12 years prior to today, it was around 30%. It's a big jump. Now, ERM is not perfect. I'm not aware of anything that's perfect. ERM is definitely not perfect. And it mostly does fall back to the implementation or the monitoring of it. Now, more specific failures can be linked to not accepting ERM as kind of the behaviors of our ERM and not making it part of the company culture. And it's hard to change any culture, but even a company culture. It's pretty difficult to do that. So not embracing those behaviors. Not awarding those who do embrace the behaviors. So some incentives, lack of incentives. We're talking about failures here. Having an ERM program in place and not listening to the risk manager or the chief risk officer, so CRO, chief risk officer, not listening to them. If you have a CRO and they're telling you a way to manage a portfolio of risk, you should probably listen to them. Too much reliance on historical data. That gets us off. That gets us off. And then just kind of there being a status quo. We're just going to run with it. We'll hire a CRO. I don't know what he or she does. We'll just hire them and say that we have an ERM program. Boom, we're done. Okay, it's hard not to do that. But it can have negative consequences. And negative consequences. All right, so this is a very, very brief introduction to ERM. We will spend more time talking about it later. Okay. But what we need to note is just the base definition and some of these failures here. A lot of it is kind of the implementation and monitoring too, just like a standard risk management process. Okay, because all of this looks like implementation and or monitoring issues. Now, before we talk about other ways to manage risk that fit to this chapter, before we talk about that, we need to know a little bit about the insurance market, because some of these alternative risk transfers found their beginnings, okay, or at least their incubation period came about in an insurance market. Okay, so we have to know just a little bit about the insurance market before we talk about these other two ways to mitigate risk or to transfer risk. Okay. Basically what we see a cycle, the underwriting cycle. We see some consolidation. Specifically, we do see a good bit of that in health insurance. And these two things and also within this, we see these alternatives that I want to take some time to talk about. Okay? So I want to lay down the basics of the underwriting cycle. Just know that there's a decent amount of consolidation, mergers and acquisitions. We won't have a full slide on that. And then we'll have a few slides on ways that we can kind of shift some risk to capital markets through swaps or bonds. So the underwriting cycle then. It's cyclical. If someone says they know exactly what causes it, I'm very skeptical. If someone says there's a causal link to us seeing what we call a hard market or a causal link to a soft market, as someone with a PhD in risk management insurance, I would doubt that. But there is a cycle. It happens. There are sways. And what we see in this is we can see very high expenses for insurers. So we have a hard market. Okay. Their claims are pretty high. So they're much more stringent on underwriting and who they select. On the other end of the spectrum, maybe claims are lower, premiums are good, money's coming in. We'd have a soft market. So underwriting standards would not be quite as stringent. Might see more policies. Maybe risks that we would not generally insure, a little more open to. We often use the combined ratio. Now, we will be working with the combined ratio after exam 1. So all that you need to know for now is we have collected all the primary expenses tied to our policies. These are not all the expenses that an insurance company faces, but just the expenses tied to their policies. And we scaled that or divided that by how much we're bringing in from those policies. So it's, from an accounting perspective, it's a loss ratio, expense ratio. But specifically, we have separate loss and expense ratios for insurers, and then we have the combined ratio. So ideally, we want this to be very low. We don't want to pay out more than we bring in. If this is above 1 or 100%, that means we're paying out more than we're bringing in. And knowing nothing else about it, we'd say the business could not sustain itself. But it can. It can. So even, as we see here, when we have periods So this is from 1956 to 2008, and I have a little more recent data after this. Here's the 100 mark, 100%. There are plenty of times that the industry is paying out more than it's bringing in if we're looking at combined ratio. But we don't see many failures, definitely not on a large scale. Because we go a little bit, so we see it here too, 100% being right there. But we can offset this, okay, with investments. So as we take in those premiums and we earn those premiums by providing adequate coverage, we can invest those premiums. So if my combined ratio is 105%, if I'm making back another 7 to 10% on investments, I'm good. My bottom line's good. If that's all we know about that scenario, I'm fine. Now, there are a number of things that influence this. A causal link, I haven't found one. And I would, again, be skeptical of anyone who said that they did know a causal link. But one thing we worry about is the capacity. What's the net of our assets and liabilities? So if we can't make it back on investment returns, we do kind of concern ourselves with the surplus or the extra capacity. So if my assets are higher than my liability, okay, I have a little bit of surplus there. I can use that. If it's cash, I can pay out my claims via cash. If there are other assets I can sell to liquidate and then pay out my claims, it's fine. So surplus is important, having a little bit of positive net there. So it's just equity from an accounting perspective. And then investment return. Those two things are what offset, surplus and investment return. So I have money saved up, essentially. I also know that I'll make a little bit on my investments. All right. So now that we've brought that into the picture and we know a little bit about surplus and that capacity, insurance companies care about surplus and capacity. I want to have just a little bit because I know that with a lot of my lines, I'm going to be paying out more than I bring in. So I want a little bit of capacity because these underwriting cycles. Well, what if there's a catastrophic loss or a clash loss? Okay, so catastrophic risks we define, all the units are highly, highly correlated. You think about a named storm or a hurricane coming through. If it hits one house, it's going to hit a lot of houses. So it's highly correlated. Doesn't help our pooling at all. And that's problematic. Insurers face those types of risks. It's ideal for it not to be catastrophic, but some are, or some are highly correlated. So what if I'm worried about my surplus due to a catastrophic event? Well, we could reach out to financial markets, offer a bond, so that will be debt for us, offer what's called a CAT or catastrophe bond. Okay, so securitize this risk. It would let me, as the insurance company, skip or defer, let's say, those payments on the bond so that I can pay out my claims for that catastrophic risk. So if you guys buy a bond from me, a CAT bond from me, and I'm an insurer, and a hurricane comes through and a lot of my policyholders are affected, then I have the contractual right to say, all right, I can't pay you guys right now. I may even dip into the surplus and the collateral to pay for these risks. But this does increase my capacity. Now, there are a couple of contractual terms. That event has to occur. I can't just say, sorry, I'm not going to pay you. Or I want this money that you're promising to pay me. Okay, sorry, no interest. You don't get any interest on it. I'm just going to keep it. No, a trigger event has to happen. The most common one is a named storm. So tropical storm, hurricane, a named storm. They don't have to guess the name. They can just say named. And the funds, the collateral, they're held in a special purpose vehicle. Held in a special purpose vehicle. So for your notes, this video here, I highly suggest watching. When you do watch this, the only thing I need you to keep in mind is it's a sell on cat bonds. They're trying to sell them to you. So it's a bit heavy-handed, but it does not say anything that I can identify as false. So I would suggest watching this on your own time. But the basics are, you guys come to me. I'm an insurer. I offer a cat bond. If that named storm happens or that trigger event happens, it may be that you don't get any of the collateral back, but you definitely won't be getting those interest payments that I promised you. I take that and pay for my policyholders. Now, what do we get out of this? Okay, we being you, the investors, but also me, the insurance company. The insurance company gets to shift a little bit of that catastrophic risk to financial markets, and I get to bolster my capacity. That's what I get. You guys as investors, you get access to a security that's not really related to the market at all. So cat bond losses don't correlate that much at all with standard market conditions. So if you do want to diversify, in this case we're putting together a portfolio of different assets with very different risk. Okay, if you do want to diversify from market risk, cat bonds can offer that. And cat bonds do, and you'll see in this video, they tend to, on average, the payout's been slightly higher than the market. We would assume there's also maybe slightly higher risk, but that's the gist of how they work. And again, that video does an excellent job of going over that. So I would suggest maybe giving that a quick view prior to your first exam. All right, so that's cat bonds. Questions about that? So it's a debt instrument for me, the insurer. It's an investment for you guys. If you're also a policyholder, it means that your insurance company might be able to pay out a bit quicker than normal, or at least they won't have to go through other means to pay out. It's rarely a problem, but an example is in 2017 when Harvey came through Texas, Progressive actually stopped writing new homeowners and auto policies for about 2 to 4 weeks so that they could shift a lot of their focus on helping their policyholders who have been affected by Harvey. You know, I'm not saying that's good or bad management. If I were a policyholder, I think that would be great. If I were an investor, I'd be a little worried because you're not writing new policies. Had they had a cat bond, or maybe more, maybe they had a cat bond and it wasn't enough, they could have maybe potentially circumvented that and wrote policies as well as handled the claims of their current policyholders. Okay. I don't know that for sure. I don't work for Progressive, but just something to think about. So this can be a problem. Surplus, very short term, can be a problem. Now, Progressive, they did not have a surplus issue. There were just a lot of claims coming in, and their claims department was just getting clogged up. That's all it was. And I think they did a very good job. They also had a lot of that market as well. So that's not me kicking them to the curb or patting them on the back, just an observation. Now I've got a little bit here showing cat bonds over time. If you're curious, so they're far more popular now. We look at issue amount and then what's still outstanding, because some of these last longer than a year. They tend to be relatively short term. I'm not aware of any that are over 5 years. They tend to be relatively short term. And we could probably go back to 91, 92, when we had some what were called ARTs, alternative risk transfers. You might could call them a cat bond. Another interesting thing about cat bonds, with one exception at this point in time, with one exception, they're all property and casualty, and most are tied to hurricanes or named storms. That one exception, in 2019, Aetna issued a cat bond. So the first cat bond issued by a health insurer. They issued that cat bond. It's not tied to a storm. It's tied to their loss ratios and a few lines of their the products they offer. So if they have to pay out more than a certain amount, I believe it was 70-75% for loss ratios, then the cat bond would call. That would be the trigger event, and they could use that to pay out for their claims. So pretty interesting. I don't think they had a claim on it. Now, credit default swaps. Okay, so they're also quite interesting, and they are another way to transfer risk. The primary risk here that's being transferred is default risk. So we can think about default risk in and of itself. We could probably argue pretty easily, I think that's a pure risk. You either default or you won't. You either make the payments you promise to pay on this bond, or you won't. So we've got a pure risk here. So what was a credit default swap doing? So it's a contractual agreement, it's a risk transfer. And what I would do if I'm worried about some of my creditors being unable to pay, or debtors, excuse me, being unable to pay me back, I could get a credit default swap, let's say from AIG. And if they are unable to pay me back, not AIG, the other firm in question, I have a bond from them, a loan, they can't pay it back, then AIG will pay me back. And I pay AIG a premium to do so. So it could be that I'm expecting a 10% return, coupon rate on this bond. I swap that default risk to AIG and I pay them 2%. And if there's a loss, they'll reimburse me completely. They always get the 2%. I always end up with 8%, right? I'll get a 10%, but I'm paying Aetna 2. Whether that bond pays out or not doesn't matter for me financially. I do care. That's why I initially bought the contract. But now that I've swapped it over, AIG will pay for that risk. So that's the very gist of it. Now, 2007, 2008, most of the default was tied to mortgage-backed securities, usually in the lower tier of those. Now, here's the second video that I would suggest watching. It's a Khan Academy video, and it goes over, again, it's just a snapshot of this. So that's your online assignment, those two videos, your online assignments, okay, along with backpack. Now, so the question then, are credit default swaps, are they insurance products? The short answer and the right answer is no. They're not really insurance products, okay, for a few reasons. Okay. The sellers of these swaps don't have to maintain reserves. Insurance companies have to have reserves. They care about surplus. They care about capacity. Not so at the time being for credit default swaps. They're not based on, we'll just say, pooling. Because AIG then could write 100 credit default swaps on that one bond, the one that I'm concerned about. Just because they have a sample size of 100 doesn't mean they've done anything, because all 100 of those credit default swaps are tied to the same default risk, meaning they're all perfectly positively correlated. So we get no positive effects from pooling, which is usually how we like to reduce our risk, or one way. So you don't really get pooling, so we get the law of large number of effects. Because that default risk, no matter how many times you segregate it out and split it up, it's the same. If it's on that one product. You could bundle a few different credit default swaps on different bonds, sure. But if they're all based on mortgage-backed securities in the lowest levels and tiers from 5 banks, not much diversification. And then finally, in the example I gave you, I buy that credit default swap. I have that bond. I buy a credit default swap on that bond from AIG. So AIG says, hey, if this firm can't pay you back, we've got you. You just give us 2% or a certain amount, a premium. I care. I don't really want the bond to fail. So I buy the risk. I have insurable interest. There's nothing stopping you guys as external investors buying that same credit default swap. You don't have to have the bond. So then you're hoping that the credit default swap pays out. Therefore, you're hoping that that firm fails. They could or they could not. It's no longer a pure risk, it's speculative risk, and you have no insurable interest. Okay? So they're not, for all intents and purposes, they're not insurance products. They're not insurance products. And then I have a fun video here that you will not be tested on. Has anyone seen the movie The Big Short? Yeah. Okay. So they go into a lot more detail in the mortgage side of this, but they do have a 5-minute clip here. It's funny if you're bored and watch it, or actually just watch the movie if you haven't. I think it's pretty fair. It has it's Dr. Michael Burry, and he's played by Christian Bale. Yeah, Christian Bale. So it's a good movie. Doesn't really fly too fast and loose with the facts, and it's enjoyable. But anyway, short clip there. If we were not in a hybrid class, I would show it to you and I guess get some laughs. But you can watch that on your own too. But your online video assignments are the credit default swap and the cat bond. I think they will help you. They're not necessary. I've given you all that I want you to know for now, but I think they are 2 very good videos. So I would suggest watching those. And one's 3 minutes long, and the other, I think, the Khan Academy video is about 7 or 8 minutes long. But credit default swaps take a little bit more time to kind of iron out the details. Okay. All right.